This is the Asia Trade. I'm Shery in Seoul.
I'm Haidi, Stroud-Watts in Sydney. The top stories this hour. The market sell-off shows no signs of easing, with futures signalling further huge losses in Asia and the US. The yen and treasuries strengthening as haven plays. China investors bracing for an ugly Monday when markets reopen following Beijing's trade war retaliation. Key commodities are also opening under pressure. But the Trump team remains defiant. The Treasury Secretary rejecting the view that a trade war will trigger a recession and defending the new tariffs as necessary.
All of this, Haidi, despite the massive sell-off that we've seen in the U.S. We're talking about the S&P 500, of course, seeing its worst day since March 2020. And you can see U.S. futures pointing to the downside of more than 4%. The Nasdaq 100 already in bear market territory. Now futures losing about 5%. The S&P 500 lost $5.4 trillion in market value in just 2 sessions. And right now, signs really showing a potential for more of that sell-off continuing in the Asian session, with futures trading to the downside. Fed Chair Powell continuing to say that he won't rush to react to the financial market turmoil or to the Trump tariffs. We can see, of course, that despite these wars, we have seen the sell-off and the safe haven moves continue. The Japanese yen has strengthened. Take a look at how we're setting up for the Asia session, because we're talking about the Japanese currency now at the strongest levels since October in about 6 months. The Nikkei also has fallen to the lowest level since August, and you can see Nikkei futures pointing to the downside of almost 4%. Sydney futures also more than 4%. We'll continue to watch that bond market rally. We saw treasuries rallying. JGBs have rallied throughout the past week. We'll be watching the offshore yuan. 729 is the level right now, but we're talking about the weakest level since February, and they're coming back from a long weekend. They're also coming back after Beijing retaliated to U.S. tariffs. Here in South Korea, where I am, the Kospi is at the lowest level since February. And what a time to be here in South Korea, where we're launching our new studio, Haidi, because we have so much to cover, especially when it comes to U.S. tariffs. Of course, South Korea is a bellwether when it comes to global trade, and we have so many idiosyncratic news as well to cover. We just talked about how President Yoon was ousted by the Constitutional Court. We'll see the ramifications as we head towards another presidential election.
As you say, idiosyncratic when it comes to some of those domestic challenges, and there are plentiful of those domestic challenges when it comes to each of these economies. But the common theme, of course, is how all of these economies, central banks, governments are really contending with the global impact and potentially recessionary and stagflationary impact of these Trump tariffs. If you take a look at really the market open that we continue to brace for, just here in Australia, we're an hour away from the start of cash trading, and look, your pension portfolios are really looking pretty ugly at this point, right? The ASX bracing for that $100 billion plus wipeout after that meltdown on Wall Street. We're seeing the Aussie dollar resuming its kind of prime position as the pain trade here. We fell to about 58 US cents at one point before coming back, and it does look like that pressure continues unabated as well. But take a look at this extent of the global sell-off when it comes to just a sheer drawdown we've seen over the past few days from all-time highs. The stock 600 seeing a decline of 12% there. Certainly some of the steepest declines coming through from parts of Asia as well. The Nikkei 225, because Japan hit with that double whammy of broader tariffs as well as those auto sector specific tariffs, as well as the MSCI China falling by almost 45%. And we'll be watching that very closely, of course, when Chinese markets rejoin the fray today. Well, Bloomberg's Tyler Kendall joins us now from Washington for the latest. And as we see financial markets, economists and policymakers globally really trying to make head and tail out of the potential implications of U.S. tariffs, we're still hearing basically defiance and justification from the administration.
Yeah, hey, Haidi and Shery. At this point, the White House really holding firm, even as senior administration officials confirm that more than 50 countries have reached out to negotiate. The question is whether or not the U.S. will negotiate, and what would it take to get them to the table. A source familiar does tell Bloomberg News that at this point, President Trump is really just focused on the long term. We heard that rhetoric doubled down by senior administration officials over the weekend, who really said that any exemptions or carve-outs could potentially undermine investment when it comes to reshoring manufacturing. manufacturing in the U.S. as the White House contends that their goal here is to address what they call structural issues with the global trade imbalance, even amid, as Bloomberg Economics estimates, some pretty high stagflation and downside risks. Now, importantly, we should note that President Trump has signaled some sort of willingness to strike a deal. He said that he would need to see something phenomenal, in his words, in order to make a deal happen. Remains to be seen what he would characterize exactly as phenomenal, though it likely would have to include more than just lowering tariff barriers. For example, President Trump over the weekend confirming that he did speak with the leader of Vietnam, who has offered to lower their tariffs to zero. President Trump said that he told them thank you, but let's continue those negotiations. We're going to be watching closely those non-tariff barriers this White House has pointed us to so often when it comes to lax IP protections, regulations, the VAT, digital service taxes, and whether or not they make their way into this conversation in a meaningful way.
In the meantime, we've heard of protests across the United States against President Trump as well as Elon Musk. What's the public sentiment been like?
Right. Well, at this point, it's been sort of difficult for Democrats to coalesce around countering President Trump's agenda, considering that Republicans hold firm in both chambers of Congress. And up to this point, President Trump has really enacted much of his agenda unilaterally. Just look at the tariffs we're discussing as one point of example. Now, these protests really were focused on the DOGE efforts. We know cutting back on the federal government, both in workplace, but also trying to strip some of the funding that goes into some key programs as this administration makes spending cuts a key priority. Now, importantly, it did come the same day, these nationwide protests, some of the largest that we saw, as the Senate passing its own budget blueprint resolution. And I bring that up because while not a done deal, the House needs to consider it. Both chambers need to agree before they actually write out some tangible craft that legislation. But one of the big sticking points here are spending cuts, and Republicans in the Senate lowered their spending cut threshold over concerns to programs, cuts to programs like Medicaid. We started to see that rhetoric also pop up in the protests over the weekend about what this could mean for some crucial benefit programs.
Bloomberg reporter Tyler Kendall there joining us from the White House. We're also bracing for a grim Monday when it comes to the Chinese markets. They return from an extended weekend. And we also have to factor in its retaliation to U.S. tariffs. Let's bring in our China correspondent, Min Lo. So, Min, we are, of course, seeing that huge downside, even when it came to Chinese stocks listed in the U.S. So what should we be watching out for in today's session?
Yeah, definitely a lot of catching down to do for Chinese markets after being closed on Friday for a public holiday, because we saw that big sell-off in the U.S. and that's being reflected in some of these Chinese stocks. As you mentioned, you look at the Nasdaq Golden Dragon, it's down close to 9%. We are seeing similar sell-offs in some of these ETFs tracking Chinese stocks as well. And if we do see a decline to a similar extent in the Chinese indexes today, that could put those gauges into a technical correction or a bear market, really ending that very nascent recovery we had seen in Chinese equities a year to date so far. And Goldman Sachs, for example, had cut the price target, the 12-month price target for some of these major indices, including the CSI 300 and the MSCI China, given the risk events going forward and the pressure for profit taking. And of course, we are watching the yuan very closely because the PBOC did weaken the fix on Thursday by just about 0.1% or so. Will the government or the PBOC still continue to support the yuan, or will they weaken it to just blunt the impact of tariffs? We did get commentary from the People's Daily, the Communist Party mouthpiece, early this morning, saying that the government, the PBOC, could cut rates or triple R as necessary, and that could be seen as maybe an early sign this morning to calm the market jitters ahead of market opens later.
Because the retaliatory 34% counter tariffs took some economists, including ones here at Bloomberg Economics, by surprise, right? Does it suggest that they're less open to negotiations because there's quite a bit of inflationary risk in countering the US tariffs?
Yeah, I think it's clear that China has repeated multiple times they are open for dialogue and negotiations. We see that again in this morning's editorial on the People's Daily. They are not closing the door for negotiation, but they want dialogue as an equal partner. And this is really reflected in the countermeasures so far, the 34% tariffs on U.S. goods, seen as responding in kind proportionally to those U.S. reciprocal tariffs on Chinese goods. Again, a signal here that China is not just going to take this lying down. They're going to fight back. They had also come up with a series of non-tariff measures, including export controls on more than a dozen U.S. companies, limiting the export of certain rare earth materials, stopping the imports of sorghum and poultry from a couple of U.S. companies. And these are still seen as pretty targeted, mainly targeted at those agricultural and defense sectors, which are Trump's key constituencies. So whether or not Trump will take that opening, though, is a different question, because we know Scott Bessent had previously said if any country imposed retaliatory tariffs, the U.S. is just going to raise tariffs even further. And don't forget, there is also the TikTok deal in the mix. The deadline has come and passed, but Trump has managed to secure another 75-day extension to that deadline after China had reportedly withheld approval for that deal.
Thanks, China correspondent Min Min Lo there. And in fact, we are hearing from President Trump speaking at the moment, saying that he's not making China a deal unless the trade deficit is solved. He's saying that he has spoken to European and Asian leaders when it comes to tariffs, and that the China trade surplus remains unsustainable. He's also addressing the extraordinary levels that we've seen when it comes to the market sell-off, right? Saying he cannot say what happens to markets, but he's not intentionally engineering the market sell-off. Well, at the moment, we are seeing that safe haven demand continues to build as Trump's team rejects a view that tariffs could send the US into a recession. Let's bring Garfield Reynolds, who leads our Markets Live Asia coverage. And we've also heard that reaction from Larry Summers saying as well, look, you know, the worst could be yet to come.
Well, absolutely. It's putting my geek hat on. One of the fascinating things about this sell-off is that it is like the sell-offs that hit when COVID occurred and when the GFC got going, when Lehman went bankrupt, and the days after that. Now, in each of those cases, you had real, palpable, immediate economic harm that was occurring. Lehman led to a global credit crunch. The global financial system literally stopped working at times in the weeks following Lehman's bankruptcy. And the world literally stopped working, so to speak, amid the pandemic. We don't have anything quite like that here. We do have some immediate impacts, but most of the impacts from tariffs are going to be over the coming months, including the impacts created by the extreme uncertainty, which is a warning against getting too excited if there are some ameliorations negotiated, because you're still going to be in a situation where businesses are going to be wondering, well, how do we deal with this? What do we do? So we've seen markets to some extent get ahead of whatever the real world impacts might be. That doesn't mean that the markets have gone as far as they can, because the real world impacts will then create a feedback circle once they start to happen.
We're seeing the Aussie 3 yields extending that slide now. The haven bid just continues, right? And are we just kind of seeing the standouts continue to be treasuries, yen, gold?
Well, certainly the yen, possibly treasuries, but treasuries have that concern hanging over them that the logical response, I hesitate somewhat to use the term logical, but some economists have pointed out, if the tariff policies do indeed cause a hit to growth, then logically the administration, especially if the Fed is going to remain on the sidelines because of concerns about inflation, the administration should move to ease fiscal policy, i.e., go ahead with the tax cuts, and in particular maybe go ahead with them without worrying too much about immediately meeting them with spending cuts. The economy looks like it's slowing because of the tariffs. Well, one way to fight against that is by boosting spending. Boosting spending would mean more treasuries being sold. That could be a negative for treasuries, along with the situation if the Fed really does say, no, we're not going to cut rates until we're sure the inflationary shock from tariffs has passed. So that casts a little bit of concern over treasuries as a longer-term haven. There have also been some concerns raised that what could happen is countries would be going, well, if the US is going to be such a poor global partner economically and politically, and in particular if the policy creation process is going to be as chaotic and as opaque as these tariffs have been, coming up with this formula that most economists say has nothing to do with how tariffs actually work, then in that case, why do you want to go on holding US assets at all, including the dollar, including therefore treasuries? You might find, in fact, that government bonds of places like Australia and Europe and elsewhere, they will prove a more secure haven because the central banks there don't have any real barriers to cutting rates in order to help their economy, because US tariffs are unlikely to deliver much in the way of inflation to them.
And some have even talked about Chinese assets potentially being an alternative, but at the same time, given how embroiled they are in this trade war. Take a listen first to what the Macro Associates CEO Nouriel Roubini had to say about the China-US tit-for-tat.
And when it comes to Xi Jinping, there's the beginning of this game of chicken between Trump and Xi Jinping. We started with attacking them, they retaliated. We may retaliate, they're going to retaliate. That's going to lead to a full-scale trade war.
Chinese assets coming back from a long weekend. What are we expecting today, but also in the longer term when we're talking about the two largest global economies in this tit-for-tat trade war? What are the implications for the rest of the world?
Well, I mean, the implications for China to start out with are that you could see a sell-off at the open. You could also see the damage being much more limited there. After all, China, there's already a piece out in the People's Daily underscoring the idea that China could take policy steps to help its economy. And if you say that the Trump policies are shifting the US towards some sort of an autarky, China already got there. It's got capital controls. It's got a willingness to intervene in sectors of its economy in order to target what it wants to be going on in its economy. So China might actually prove in that instance to be, especially in the longer term, something of a haven when it comes to the performance of its own assets. I don't really think Beijing wants to see the Chinese stock market suffer the sort of collapse that we're looking at in US and other stock markets, so they may seek to engineer something other than a market meltdown. Looking further abroad, looking to the rest of the world, anything that impacts Chinese growth is going to do plenty of damage. We've seen what's happened to the Australian dollar, dropping on Friday by the most since 2008, and it's continuing its declines. You're looking at, again, that's part of the reason why you would expect the ECB, for example, to be biased towards rate cuts, is because Europe is going to get hit if there's a hit to Chinese demand for its goods and its services that it sells to China. So that's the wider impact. The big question is, when it comes to a trade war, China looks to have been preparing for one leading into the Trump presidency. So we're going to find out if those preparations were sufficient.
Bloomberg's Garfield Reynolds there joining us with the latest on the markets. As we have plenty still ahead on the Asia trade, we look ahead to South Korea's elections with the presidential candidate from the Reform Party. Fibonacci Asset Management also joins us here in our new Seoul studio for more on the markets. And also we discuss tariffs with the former South Korean Trade Minister Han-Koo.
Also ahead, we discuss the trade war recession risks. Harvard Kennedy School professor Carmen Reinhart will be with us. Plus, CLSA unpacks how the latest US tariffs will impact Japan's auto sector outlook. This is Bloomberg.
South Korea is preparing for federal elections after the Constitutional Court upheld the impeachment of former President Yoon Suk-yeol. Analysts are expecting the transition of power to set the stage for a shift towards progressive economic and social reforms. Meanwhile, officials say they're closely monitoring financial markets to maintain stability and will respond promptly to Trump's tariffs. Joining us exclusively is Lee Jun-seok, presidential candidate of the Reform Party here in South Korea. Great to have you with us.
Thank you for inviting me.
I asked you before we came on air about the future of the conservatives here in South Korea. You're actually doubtful of an existing future itself.
Oh, I'm going to have to question, does the conservatives in Korea do have any future, right? Because, I mean, two presidents in a row from the conservative faction has been impeached. So we are seeking that a future has to come with a really serious reform. So our party is seeking for such reforms. Yeah.
Is it more difficult also because we're seeing these U.S. tariffs? Conservatives have closely aligned with Washington, and now they seem not a very reliable partner.
If you go outside in Seoul and if you see in the streets, there are people from conservative faction waving the American flag. And they are thinking that Americans are going to come to help the impeached president, but it didn't happen. So they're kind of in despair right now. And the recent tariffs by Donald Trump has been causing a real turmoil in Korean industries because they imposed 26% reciprocal tariff on Korea and 46% on Vietnam, which is a major manufacturing facility for Korea. And Donald Trump refused to put any tariffs on Russia yet. So, which means that from Korean point of view, does that mean that we have to move our manufacturing facilities to Russia? Those kind of all these questionable decisions he made is putting Korea into turmoil.
Do you think
right
that
now.
will affect voters' decision in the presidential election?
Definitely. Before, for the conservative faction of Korea, anything that U.S. decides was in favor of Korea, they thought. But now they think otherwise. So, which means that Korean people are going to pay more attention to diplomacy and, say, trade issues in this upcoming election.
How is your conservative brand different from the rest of the other conservatives here?
Well, we were going for the impeachment in the recent impeachment trial. And at the same time, we believe we are representing the younger generation of Korea, which have different views on international politics and, say, trade issues and all these kind of stuff. Because older generations in Korea, older conservatives in Korea, they were grown in a developing Korea, which means that they want to get exempt from all these international burdens that Korea had to carry. But whereas the younger generation think that we can carry more burdens in the international sector and we can voice more in the international sector.
The younger generation that also includes many angry men, how would you respond to people who say that you're actually fueling some of those gender divisions here in South Korea?
Well, there has been gender divisions for about 10 or 20 years to now because in Korea, as you know, the Korean society was after Confucianistic ideals, and now society is changing. So the role of women in Korea is changing rapidly. So we are adapting to such changes right now. And some people are a little more faster than other people, and some people are a little more slower than other people. So we are seeing those gaps in gender roles and gender equality issues. Yeah.
So how will you tackle that gap?
Well, I'm going to have to say that I got education in the U.S., so I'm mostly ahead of most of the people in those issues, and people blame me for...
The U.S. seems to be retracing a lot of the progress that it
that's
made
because
when
of
it comes
Donald
to
Trump,
equality.
so I'm not going to say U.S. in general is moving that
Trump
way.
of South Korea at times.
Well, I deny that because I really am against kind of policies that Donald Trump is laying out right now, including those free trade related issues and those kind of stuff. So I'm going to have to say there are some things that I have to make up on, but at the same time, I'm going to try to advance Korea into a more, say, developed country, and at the same time, pay more attention to these kind of social issues, and those kind of changes are what the younger generation, younger conservatives in Korea are actually looking forward to.
You'll need to actually win in the presidential elections, but you trail main candidates right now. How will you try to overcome that gap?
Well, this election wasn't expected, so the candidates have not laid out their pledges yet. But I'm going to be more reformative in laying out my pledges, and the younger generation will definitely respond to those kind of new type of pledges that I lay out.
Will you see coalitions with different candidates?
Well, most people assume that because I'm from the conservative faction that I'm going to be aligning myself with the PPP candidates if they're decided, but I say no because, conservative faction needs some changes, and they are refusing to change right now. So unless they are catching up with us in terms of changes, then it's very unlikely in this election that we're going to be aligning ourselves with the old conservatives, the PPP.
Lee Jun-seok, it was really great to have you with us. Thank you very much for that. Reform Party presidential candidate. And Bloomberg will continue to follow this story and, of course, reaching out to other parties as well as we look ahead to the elections here in South Korea. We'll take a look at how some of these market assets are trading because we continue to see the broad market sell-off when it comes to risk assets. Also, the safe havens continuing to gain ground. We're talking about the Japanese yen, Haidi, trading past that 145 level against the U.S. dollar.
Yeah, we're also hearing from one prominent hedge fund manager, Bill Ackman, of course, of Pershing Square, really musing on and giving his views on these tariffs that have really wreaked havoc when it comes to global markets, right? Bill Ackman saying that they will suffer market-to-market losses if the market crashes, but they won't be a seller, I should say, in this declining markets. There will be buyers of great businesses at highly discounted prices to benefit investors over the long term. He does, though, point out that while it's good that President Trump has drawn the tariff and trade imbalance on a global sense to global attention, that the launch of the tariffs on April 9th is a mistake. Much more ahead here in the Asia Trade. This is Bloomberg.
We have breaking news out of Japan. We're getting the February labor cash earnings rising 3.1% year on year, which is slightly above economists' expectations. When it comes to real cash earnings, so consider inflation, and you got a contraction of 1.2%, still a smaller contraction than was expected, a smaller contraction than the previous month. As we continue to keep an eye on wage growth in Japan, of course, this will make a big difference for the Bank of Japan's policy decision at a time when the economy is also being hit by those U.S. tariffs. And we continue to hear from the BOJ Governor Kazuo Ueda saying that the U.S. tariffs have added uncertainty to the economic outlook. We have seen Prime Minister Ishiba now call the U.S. tariffs a national crisis at a time when we continue to see solid wage growth, but still cash earnings for the month of February growth of 3.1% year on year. The Japanese yen holding at that 145 level against the U.S. dollar. Take a look at the broader markets because it's that strength in safe havens that's moving the markets. We're talking about the yen at the strongest level in about 6 months as the Nikkei has fallen now to the lowest level since August, and futures pointing to the downside of, look at that, 9%, Haidi.
Shery, let's get some more analysis when it comes to the economic impact as well as the market impact that we continue to see play out there in a sea of red for Asian markets as we get the week started. Let's bring Carmen Reinhart, who's a professor of the international financial system at the Harvard Kennedy School. She previously served as the chief economist at the World Bank. Carmen, always great to have you with us, and particularly at a complex and volatile time such as this for the global economy. Let me start off with the comments that we've had most recently from the Treasury Secretary. Scott Bessent says that he sees no reason why a US recession should be on the cards. Do you think that he's correct?
I'm sorry, I didn't catch a question. Forgive me.
So the Treasury Secretary is denying that a US recession is a likelihood, or even, a slight likelihood at this point.
Of course, yes. The basic take is, with the level of uncertainty, the wealth losses, the fact that the U.S. Treasury has also been selling the view that this will bring jobs back. None of those factors are other than increasing the probability of recession. The prospects of jobs returning to the U.S. is minimal, at least over the short run. And the dislocation that we're seeing in markets is definitely creating a risk-off sentiment in which financial conditions are tightening. I think the odds of a recession in the U.S. have increased very significantly since Liberation Day. Alongside, of course, we have stagflation issue, which we should probably talk about.
We should talk about that, and we should also talk about, I'm keen to get your views, obviously, as a former chief economist at the World Bank, the global implications as well, right? Because this time around, we don't have, any particular strong counterweight to growth. In fact, China looks like it's going to be quite badly impacted, both in terms of the tariffs and the reciprocal tariffs as well.
Yes, that is a point I've made very recently, that during the global financial crisis, as the US and most of Europe slipped into recession, you had the counterweight of China. And we don't have that this time. In effect, the growth numbers for China, which already are troubling given its internal developments, are poised to also look worse. I would add to that that this kind of uncertainty, I highlight risk off, is very adverse for emerging markets. Capital flows to emerging markets are bound to suffer alongside. So it's not just a halting of the trading system in goods and services, but also in finance. And again, if you go back to a comparison of the last global turmoil, leaving aside COVID, of 2008, 2009, emerging markets, by and large, alongside China, were also a relative positive light. And emerging markets, especially in Asia, are a major target of these tariffs. So the recession risks that I alluded to in the context of the U.S. are very much a global concern, and I expect that at the IMF annual meetings, which are around the corner, of course, this will absorb the full attention of participants.
Carmen, and that recession that you talk about in 2008 lasted, 18 months or so, coupled with that collapse in financial markets. We are seeing right now futures in the Nikkei point to the downside of 8-9%. Is it more likely that if we do get a recession this time around, it will be a deeper, longer recession than what we saw during COVID? As you mentioned, that didn't really last that long.
The COVID was a very different shock. I would note that the recessions in the U.S. less so, but especially in Europe, lasted quite a long time. And I expect that the adverse consequences for economic activity globally of this turmoil has a great deal of persistence. This administration, the Trump administration, is not showing signs that this was really a negotiation ploy. They really do want to rebalance the U.S. economy back to manufacturing. So they're going to be, I think, playing a very tough game. And we've already seen retaliation on the part of China. We'll, of course, await to see what unfurls out of the EU and others. But this disruption to global markets, again, not just trade, but also finance, I think will be delivering very persistent slump.
What we've seen in the past few years, whether it's from Europe, the U.S., China, of course, is really a more interventionist sort of state, governments wanting to play a larger role when it comes to economic policy. What will the new economic world order look like to you in the next few years?
The next few years is really a very difficult call. Look, Trump, when in his first term, he reversed the policies of the previous administration. Biden came in and reversed Trump's, and Trump's came in and reversed Biden's again. Nonetheless, Trump just got elected. So we do have a significant amount of time in this administration, but permanent is not a term that I would currently be using, although I do use persistent. However, I think, to your point, I think the damage to globalization of this shock cannot be underestimated. This is pre-World War II kind of policies. And the decline in globalization did not start with this. Globalization, whether you measure the growth of global exports or whether you look at other measures of finance really peaked around the global financial crisis, and then Europe had to close its current accounts deficits. It had to retrench. Then we had Brexit. Then we had the first round of Trump and China, and now we get the largest by far of any of these shocks. So globalization, as we knew it in a long era of comparative prosperity, since World War II, has been set back. Whatever I think has characterized this most recent trend, however, I would note that future reversals from different administrations cannot be ruled out, especially in the context of an economic performance both in the U.S. and globally, that caused public uproar. Already, if you look at Trump's ratings on how he's managing the economy, the decline has been very precipitous. So I hate to think of this as a forever permanent pivotal point.
Carmen, I did want to ask, so how easy is it to reverse, the reversal of trade liberalisation, right? Because we saw in the 1930s some of those sweeping tariffs just before the Great Depression took decades to unwind. A lot of governments would be waiting out, thinking, well, just 2 more years or 4 more years, but can it be turned around that quickly?
No. In effect, I think one of the reasons why I am expecting recession both in the U.S. and globally is that reorienting trade, relocating production activities is something that takes time, and you need credibility, meaning that you need to believe that it is worth the cost and the effort to reorient. And at the moment, all we have is uncertainty. I do not think that if you look historically over the last 200 years, globalization has had long cycles. Globalization, actually, we thought we invented globalization in the more modern era. We did not. The world was, given technology changes, highly globalized before World War I. Then we had World War I and the Depression and the Smoot-Hawley tariffs and the retaliation that came with that, and globalization sank. And since World War II, this is why this is so pivotal. At the end of World War II, there were a lot of capital controls. The world was, both in the U.S. and everywhere, there were capital controls. However, in the Bretton Woods environment that emerged out of World War II, which is now under threat, trade was encouraged. So while finance was curtailed, what we saw was a steady growth in trade. But the view that once this momentum gets going, and I said this momentum has been going now for some years with this new escalation, of course, being its climax, it will unwind globalization for decades.
Carmen, really great to have you with us. Carmen Reinhart, Professor at Harvard Kennedy School. A little bit later on, we'll be speaking to India's Commerce Minister Piyush Goyal following Trump's decision to enact 26% tariffs on India. He'll be joining us live from the India Global Forum in Mumbai. That's at 4 p.m. Hong Kong time for that conversation. Well, we have seen this haven trade play out when it comes to gold, but take a look at what we're seeing when it comes to other commodities as well as broader energy markets as well, given that we have seen that sell-off really taking hold in light of these concerns over the impact of Trump's tariff turmoil on global demand. We're even actually seeing the haven appeal of gold that has driven spot gold prices to record highs really fading over the past week. And it really does show perhaps that investors are just taking profits where they can. The extended weakness that we're seeing at the moment, 1.6% softer, is perhaps a little bit counterintuitive given that it is still at haven play. But as our MLive bloggers suggest, we may be seeing cross-asset managers just needing to find find whatever profits they can get to fill holes in equity portfolios. When it comes to copper as that sort of growth proxy and China proxy, that is pretty clear there. The bull run just turning into a rout as the reality of tariffs really starts to hit there. Just 2 weeks ago, we had copper prices surging as we thought that US tariffs threatened at that point would squeeze global supplies. Now we're seeing one of the worst ever sell-offs for this market. And taking a look at oil as well, we're off by 3.5% there as crude markets continuing to confound with these global trade risks. Shery.
And Haidi, we continue to see the reaction around the world to these tariffs. Vietnam has offered to remove all tariffs on U.S. imports after President Trump announced a 46% levy on the Southeast Asian nation. In a letter seen by Bloomberg, Vietnam's Communist Party chief To Lam also asked Trump to postpone the implementation of the tariff by at least 45 days. Meanwhile, Malaysian Prime Minister Anwar Ibrahim says his country will lead efforts to coordinate a regional response in Southeast Asia toward Trump's tariffs. He adds efforts are already underway to engage the U.S. to find a mutually acceptable solution. Israeli Prime Minister Benjamin Netanyahu will meet President Trump on Monday to discuss tariffs and other issues. Netanyahu will be the first world leader to meet Trump since his latest tariff announcements. An Israeli official said that while tariffs prompted the meeting, the two leaders will also discuss Gaza, the role of Turkey in Syria, and shared concerns over Iran. Iran has responded to a letter from Trump demanding a new nuclear agreement by warning against any military aggression while committing to regional peace. Iran's supreme leader said it's pursuing a civilian nuclear program, not weapons, and will respond to any threats with full force. The response adds Iran won't hold direct talks with Trump, but is willing to pursue indirect communication. We have more ahead on the Asia trade. This is Bloomberg. This is a setup across Japanese markets as we're getting breaking news at the moment. The Nikkei and the Topix futures are now currently suspended. They've now traded limit down. Of course, we had seen losses of more than 9% for those Nikkei futures as the Nikkei already closed at the lowest level since August. We're talking about 4% gap from that bear market entry from its December high at this point, while the Topix already entered a technical correction at a time when the Japanese yen continues to strengthen against the U.S. dollar. You can see upside of more than 1% at the moment at that 145 level against the greenback. President Trump's 25% tariffs on imported cars also taking effect last week. Of course, that reverberated in the Japanese markets around the world as well. We're watching those car makers closely. Nissan had decided to stop selling a pair of Mexican-built Infiniti SUVs in the U.S. market, while Toyota is cutting overtime at a factory in Mexico. Joining us now is Christopher Richter, senior research analyst at CLSA, who covers Japanese autos. Christopher, great to have you with us. So who are the most exposed and vulnerable at this point among Japanese automakers?
The ones that are most exposed are ones with really heavy export exposure, imports into America. So this would include makers like Mitsubishi Motors, Mazda Motors. I see the Nikkei wrote last week that Mazda could see its operating profit in the coming fiscal year come down by 100 billion yen. That's pretty close to our estimates. The ones that are more local production heavy, like Toyota, like Honda, may have less impact. I think the main impact of these tariffs is it's going to create a lot of inflation in vehicles in America. We estimate that demand, first off, the inflation will raise prices by over 14% in the U.S. and the knock-on effect of that is going to be that demand is going to get lower in the U.S. So makers get exposed from lower volume. And consumers see higher prices, the classic definition of stagflation. So it's bad news all around. I think makers like Toyota, Honda, at least their exposures to imports, including components, are not that terribly different than the Detroit makers. So so I think they will be better positioned. But it's really these ones who import most of their product that are in a bad place.
What about the fact that we are still waiting to see what's going to happen to auto parts, especially when it comes to U.S. tariffs and how exposed some of these car makers would be depending on those components.
Yeah, I think it's almost certain, given what the Trump administration has already done. You know, the tariffs on the parts are coming. They've said, you know, May 3rd is the date for that. And, you know, it makes sense. If you want to pull production back to the U.S., you've got to tax components. Otherwise, you know, then makers say, well, OK, we'll just import a lot of parts and move the final assembly to the U.S. And Trump has already made comments that he's on to that kind of thinking, complaining about knockdown production. So, I'm pretty sure that components are going to see taxes as well.
Is there meaningful alternatives in terms of other markets that these, in particular when it comes to the retooled supply chains, the new models that could have been a sales boost and now probably are not going to? Are there other markets that could even come some way to meeting that demand?
Sort of around the edges, but not in a big sense. I mean, the U.S. has been the largest market and the most profitable market for the Japanese automakers for many years, for many decades. So, you don't change that on a dime. And trying to shift that demand to Europe, to China, more in Japan, Southeast Asia, you can do a little bit of that, but you're not going to be able to completely turn the picture around.
What does pricing elasticity or consumer elasticity look like when it comes to preferences for car brands?
I think there's a little bit, that favors brands that have a lot of brand equity for quality. So I think, Toyota probably does, very well there. I think a brand that has, a weaker image like Nissan has less. But still, the bottom line is prices on cars are going to go up. Affordability for consumers are going to go down, and they've come down a lot, over the last several years through COVID and the chip shortage. So, really car buying in America just descends into being an new car buying at least descends into being a upper middle class activity.
Is there a difference of how the exposure could differ from Japanese automakers to, say, Korean automakers, German automakers in the United States? I mean, could Japan be more resilient than any of these competitors, and who ends up winning or losing in this whole U.S. tariff scenario?
I think that's a great question. When I was making my points about companies that, have a higher exposure to imports in the U.S. market, certainly that fits the bill for the Korean makers. It fits the bill for the German makers. Maybe the German makers have some advantage here because, their main imports are luxury brands like Mercedes-Benz, BMW, Audi. And so, perhaps consumers will be more resilient there. But for Korean makers, these are generally mass market brands. Consumers are price sensitive in these segments. So, the fact that they do produce, that they do import a lot. And when I've looked at, the exposure to foreign components in their U.S. manufacturing is on the high side, I think they could struggle a bit.
Christopher Richter, good to have you with us, senior research analyst at CLSA, with a breakdown of how Japanese car makers will get affected by all of these U.S. tariffs. And it's time now for morning calls ahead of the Asia trading day, and one of Wall Street's most bullish Tesla analysts has slashed his price target for the stock by 43%. Daniel Ives of Wedbush Securities sees the EV maker getting caught up in backlash against Trump's tariff policies in China, where Tesla generated over a fifth of its revenue last year. Shares have already fallen 50% from the record high in December. Goldman Sachs has trimmed targets for Chinese equity indices as the global trade war escalates. The bank's analysts see MSCI China hitting the 81 level instead of 85 in the next 12 months, and the CSI 300 at 4,500 instead of 4,700. They say the bull run will slow on event risks and profit-taking pressures, and the market may test risk case valuations in the short term until trade and policy clarity emerges. Bank of East Asia sees the Hang Seng China Enterprises Index dropping another 4 to 6% from its current levels as investors fear an escalation of the trade conflict. They also say China's export growth may decline notably in the second quarter, not just to the U.S., but also to Europe and ASEAN countries.
Shery, let's take a look at how we're shaping up. We're just 5 minutes away from the start of the staggered session here in Australia, and like we're seeing that expectation of pain across major markets opening up today, reflecting that meltdown on Wall Street. This is a picture when it comes to ASX futures. They're down by now over 6%. We're looking at the share market looking to lose more than $100 billion at the open. Of course, lots of concerns when it comes to superannuation and pension funds and portfolios at the moment. That plunge is really setting the stage for a pretty horrific day when it comes to local markets. For Australian stocks, we've shed almost 3.5% over the past two sessions as these broader trade and tariff concerns continue to rattle markets. Shery.
Japan also setting up for a sell-off. Circuit breaker has been triggered for Topix futures already. We have seen the Nikkei and the Topix already in technical correction, and the exporter-heavy Nikkei futures down more than 8% at the moment. The opens in Sydney, Seoul, and Tokyo are next. This is the Asia trade. We're counting down to Asia's major market opens and potentially a market meltdown in today's session. Of course, we have seen big losses already in the previous session. Haidi, we're coming off the S&P 500, seeing its worst day since 2020. Already a circuit breaker triggered for the Topix, as we're seeing Nikkei futures also to the downside of about 8%.
Yeah, less counting down and more just remaining in brace position, right? We're expecting steep losses when it comes to Australian markets coming online this hour as well. And it's really interesting, Shery, we're even seeing a sell-off when it comes to gold, perhaps indicative that portfolio managers are just trying to grab profits where they can see them. Larry Summers, the former Treasury Secretary, saying more pain to come. The current Treasury Secretary shrugging off these recession fears.
Take a look at how we're opening in Japan to the downside for the Nikkei of more than 2%, while the Japanese yen is holding at that 145 level against the U.S. dollar. We're talking about levels that we haven't seen in 6 months or so. From October, we had already seen the circuit breaker really triggered for Topix futures. At the moment, the Topix losing about 2%. The Topix and the Nikkei have already fallen into technical correction. In fact, the Nikkei is about 4% or so away from bear market territory from its December high. We had already seen some data showing strength and solid numbers when it comes to wage growth, but of course it's all to do with what the Bank of Japan could do next. We have seen the Topix Bank Index losing more than 20% from its peak just 2 weeks ago, as we continue to watch the 10-year yield in Japan at the lowest level since January. As we're seeing these haven moves towards global bonds, treasuries rallying, JGBs rallying. Take a look at how the Kospi is also coming online. Of course, we have seen the ouster of former President Lee Jun-seok already last week. We're factoring all of the political drama in after the Kospi fell to the lowest level since February. You can see downside of more than 4%. The Korean won holding at that 1461 level. We have seen stocks here in South Korea seeing its worst foreign sell-off since 2021. We are, of course, watching the jobs report coming up later in the week. We'll also be watching some of those big names coming out with earnings, including Samsung on Tuesday, where we're expecting operating profit to slump. Of course, it's all to do really, Haidi, with tariff expectations and just the domestic demand slump also that we continue to see.
Yeah, a lot of sort of idiosyncratic stories on top of the global challenges, right? Take a look at just the first 2 minutes, really the start of the staggered session here in Sydney. We're already seeing downside of 1.5%. This is now a third straight session of declines. This after we saw that technical correction from its peak of 10% lower on the Friday session. That really does look like it is just going to be extended now. We're seeing every sector at the moment trading in the red, and that's perhaps unsurprising given just the breadth and depth of the sell-off we've seen regionally. The Aussie dollar trading still under that 60 US cent level. We saw a brief period of respite, but certainly this has been one trade that has resumed its kind of proxy as a pain trade, both to China as well as to these US tariffs and the broader kind of risk-off proxy that it tends to operate by. Take a look at treasuries as well as what we're seeing in Australian bonds as well. Futures in treasuries jump in with that risk aversion. Australian bonds also gaining as well. We saw that the Aussie 3-year yield hitting the lowest since 2023 in this broader environment, Shery, of just severe risk aversion.
Yeah, our next guest, in fact, Haidi, says that investors should be prepared for a significant meltdown in stock prices, no matter which continent they're in. Let's get more from Jung, founder and CEO of Fibonacci Asset Management Global. Jung, good to have you with us, especially in this new South Korea studio that we have set up.
Yes, this is definitely a remarkable day, a day where everyone will remember.
Anywhere to hide at this point?
Not much, actually, and I won't lie about you. If we get a recession, we don't think there's going to be V-shaped recovery because the source of recession is politics, war, and tariff. This is all lasting for more than like a year. So this is probably going to be like W-shape or U-shape if we ever recover.
Do you think it was bad timing for that short-selling ban here in South Korea to be lifted last week?
Actually, I think the timing was actually perfect because short selling, I mean, if you short sold days ago, this is a good opportunity for you to take profit, which means you have to buy back. And that will reduce the volatility in Korea stock market. And we already see the won holding the ground. So I think although foreigners are exiting from the stock market, they're not leaving Korea because they are getting prepared to go back in.
Where do you think they'll go back in?
Well, probably sectors that relate to tariff, so manufacturing is out. But I would say Hyundai Motor is exception because most of Hyundai's factories are in U.S. will be in full capacity by the year 2030. So Hyundai should be able to produce all of the U.S. demand made in USA. So tariff will not affect it much. But if you're looking for more defensive sector, I would say invest for K-food like Samyang or Orion, or invest in K-beauty like American Pacific. I think those sectors will share most of the volatility away.
How do you feel about defense stocks at the moment, given also the big changes across the geostrategic and geopolitical spheres?
So back in the days, we lived in a very peaceful time where trade functioned as a deterrence for geopolitical tension. Now we're reversing back and becoming more fragmented world order. That means there's less cushion for war, and this current geopolitical situation is a natural catalyst for war, and that will probably benefit Korea defense stock. I think Korea defense stock will enjoy a multi-year rally from this point.
We're seeing China's 10-year yield now falling 10 bips on tariff risks, on the expectations that the PBOC will need to come in and ease, given that we now have counter tariffs from Beijing on the US. It's going to have a huge impact on China's domestic market, and we're expecting to see a pretty ugly session for Chinese equities as well. Despite all of that, do you still see a medium to longer term opportunity when it comes to China tech?
So yes, because most investors in U.S. tech will now want to escape from U.S. And if they still believe in tech rally, they'll look for other countries they can park the money in. And I think Hong Kong AI stock is where they're going to be headed next. It has risen significantly in the first quarter, but it also went through a hammering, painful period for the past 2 years. So despite its recent rally, I think it still has a lot more room to run.
Do you think we could see a currency war? I mean, so much chatter about what China could do.
Well, we may have already entered a currency war without trigger because if you look at the U.S. Treasury yield, it's already below 4%. Now, that means that Fed will be gearing to step in further. So we might have 3 or 4 cuts within 12 months. And that will naturally lower the U.S. interest rate, which will impact the currency. And countries like EU and China will also try to lower their rate. So we're going to see the currencies melt down as well.
What are the implications for traders then?
Well, for traders, they have really few options. They can either get out of the currencies that will benefit most from the tariff war, or, I mean, this is not easy for them, but I think they should look for the alternative. We saw the gold price coming down. I think in this currency war situation, the treasuries will probably lag behind the gold price. So maybe it is time for us to think serious about investing in gold.
Is the yen finally back to being a safe haven?
Well, yen has always been a safe haven.
It's not during BOJ policy making.
Right. So, but I think it will restore the status quo, and probably we'll see a lot of normalization. Yen has enjoyed some of the largest and fattest premium since way back, but we think a lot of them will be coming back to normal.
Jung, who's the founder and CEO of Fibonacci Asset Management Global. Really great to have you with us. And Shery was just talking about gold, and we are seeing quite an interesting kind of dynamic play out when it comes to gold prices, even as a haven demand that has been one of the standouts, along with sovereign bonds as well as the yen in this sort of tariff play. We're starting to see some profit taking when it comes to gold at the moment. Perhaps we are seeing really that need for some money managers to just find profits, given how these portfolios are really just under pressure at the moment. It's a much more standard response when it comes to the copper play there. Both copper and gold extending those declines as a trader war sell-off really just continues. We had some really stellar gains for copper just a couple of weeks ago as we were concerned about the squeeze on global supplies as a result of tariffs. But given the collapse in equity markets, more punitive tariffs, and specifically these retaliatory measures on China and from China as well, prompting much bigger fears around global demand and sort of infrastructure demand. That China proxy story very much coming into the fore now. Nickel off by over 5%. We're also seeing iron ore, of course, Shery, another China proxy story, down by 3.5%.
And of course, not surprising, we're watching those automakers across Japan and South Korea as well, not only because of the U.S. tariff news, but just broad risk off, right? I mean, we're talking about the Nikkei now falling about 20% from its December high. If we finish at these levels, we're talking about the Nikkei entering bear market territory as well. So we'll continue to monitor these automakers, Hyundai leading some of those declines, with Honda as well, down more than 7%. A lot of those exposed to not only selling in the U.S. market, but also because of production in Mexico as well. And we continue to watch also semiconductors, don't forget, because some of those big losers in the Korean session are SK Hynix and Samsung as well. We have more ahead on the Asia trade. This is Bloomberg.
Billions of dollars a year we lose with China, and unless we solve that problem, I'm not going to make a deal. Now, I'm willing to deal with China, but they have to solve their surplus.
President Trump there taking a defiant tone in the face of the global market turmoil triggered by his tariff blitz. He also said that the deal really hinges on an even trade balance and that he hasn't engineered the global sell-off. But as you can see, the global sell-off when it comes to risk assets and that broader play when it comes to haven demand really still continues to play out when it comes to the jump that we've seen in US Treasuries, in Australian bonds as well. Big move when it comes to the yield for the 3-year this morning here in Australia. We're also seeing that move when it comes to Chinese assets as well, as we see Chinese bonds moving on expectations of further stimulus and monetary policy measures from the PBOC, given that the tariffs as well as the counter tariffs are expected to have a meaningful impact on both Chinese demand and that inflation and growth outlook as well. So as we heard from President Trump, telling reporters he's not making a China deal unless the trade deficit is solved. It comes after we saw those levies on American goods being unleashed by Beijing, export controls on rare earths in response to the Trump tariffs. It's bringing our China correspondent, Min Lo. So, so much of this has rattled investors because I think that 34% tariff from Beijing sort of came in an unexpected way, and perhaps the signalling is that it's crossed the patience threshold or the pain threshold for policymakers in Beijing.
Yes, I think, this is a very clear signal. In some sense, one of the clearest articulation from Trump that we have heard so far in terms of what he wants to get from China, which is a resolution of that trade deficit on top of what he had said previously about the fentanyl trade. And as you said, this time China responded more forcefully and more swiftly. Instead of waiting until those tariffs kicking in on April 9th, they responded early with reciprocal tariffs, 35% 34% in kind and proportional to the U.S. tariffs. But I think it's clear that China still is not closing the door to negotiations. That was clearly stated in the ending paragraph of this editorial on the China's People's Daily, the Communist Party mouthpiece this morning. But they are taking all the measures that they can in order to prepare for the risks of these external shocks. And they're obviously sending this signal that they're not going to take things lying down. They're going to retaliate and hit hard. But everything is done in a very measured and targeted manner. No overreaction from China, despite what Trump had said. And I think that is the message that China is sending, that they're hoping that hopefully there could be some dialogue as an equal partner to the United States.
Comes to the levels of the Chinese yuan, there's been a lot of speculation that Beijing could use the yuan in order to retaliate.
That's right. I think there's a lot of speculation because the Xinhua, the state media, had actually published an article saying that China will continue to take resolute measures even after unveiling those 34% tariffs on U.S. goods. So many people are wondering what exactly does those resolute measures mean? Could China actually use the yuan again to weaponize the currency in order to blunt the impact of tariffs? But so far, we had seen China really prioritizing stabilizing the currency. We did see the PBOC weakening the yuan by about 0.13% on Thursday, but still keeping it below 7.2 yuan per dollar. Still pretty supportive for the yuan. And there are sort of different competing narratives now. Some analysts are expecting that China could forcefully depreciate the yuan to the tune of 15 to 30% in a couple of months. Others are saying that maybe China will take a measured approach, weaken it to the tune of just 3% and try to support the currency in order to push that inflationary pressure to the U.S. and also to take care of all those concerns around capital flight and shocks to the Chinese equity market. And then you have the likes of Ray Dalio, who expects that maybe China could even negotiate a deal where they strengthen the yuan in exchange for less tariffs. So it looks like really the market does not know where the yuan is going to go next. So we'll have to see what the PBOC does today.
Bloomberg's China correspondent Min Lo there. Well, economist Nouriel Roubini sees the stock market rout deepening further before stabilising. Certainly not stabilising today. He told us that while Beijing has more leverage in the trade war, Trump doesn't want to de-escalate with China.
Well, it's a game of chicken between Trump on one side, Powell at the Fed on the other, and Xi Jinping on who's going to be blinking first. You know, Trump is trying to nudge Powell to blink and his monetary policy as a way to push markets higher. But Powell knows that given what happened on April 2nd, if he blinks, there'll be a de-anchoring of inflation expectation, and those tariffs are going to lead to higher inflation. So he's not going to blink. Of course, there is a Powell put, there is a Trump put. But Powell, I don't think he cares as much about the stock market. He cares about high yields. Because if high yield spreads were to widen a lot, that's a true sign we're going to go into a recession. This past week, high yield spreads have gone up only 100 basis points. That's not yet a distressed point of view. The point about the Trump put that he doesn't care anymore about the stock market, and he believes that actually long rates have gone lower, the dollar is even a bit lower, maybe that's an easing of financial condition, so he doesn't want to blink. And when it comes to Xi Jinping, there's the beginning of this game of chicken between Trump and Xi Jinping. We started with attacking them, they retaliated, we may retaliate, they're going to retaliate. That's going to lead to a full-scale trade war. I think that Xi Jinping has more leverage. He doesn't face an election next year. He can use monetary policy, fiscal policy, and currency policy, and structural policy to strengthen domestic demand. And he's not going to give a Xi put a signal is going to start to negotiate until Trump is really serious about de-escalating. But it looks like Trump doesn't want to de-escalate with China because he wants to corner China and to lead to a radical reduction of the trade imbalance between U.S. and China. Now, in this game of chicken, I think that we end up actually that the rational thing to do for Trump will be to de-escalate, because if he doesn't, there is for sure a recession. If there is a recession, he loses the midterms, and then he's politically gone. But I think that he might not blink because one, he may think there is not going to be a recession, or he might think that if there is a recession, then he can blame it on China, and the people in Rust Belt are going to support him in his goal of reshoring manufacturing. I think it's delusional, but the probability of really collision course is really rising, and the probability of a US and global recession is rising and becomes a baseline unless Trump blinks and de-escalate. We don't know when that's going to happen.
Nouriel, I just want to jump in here. There's a real question over the weekend. We heard from a number of different cabinet members of President Trump. After hearing all of what they said, are you more or less optimistic that there will be some sort of start of negotiations in the next few weeks?
I think there will be negotiations with trading partners that do not matter. You can do a deal with Vietnam. You can do a deal with Milei in Argentina, with Israel. You may even try to negotiate something with the Europeans, but that's going to be tough because they may start to retaliate. The big thing that can help the market is if there is a call between Xi Jinping and Trump, and they say, we're going to postpone these tariffs on both sides by 90 days, and let's try to have a grand bargain. I don't think there is any evidence that that call is going to occur and that negotiation is going to start. If anything, I think there is a risk of escalation on both sides because both of them essentially feel that the other side is having some malicious intent. And therefore, I worry that collision course is going to continue. The market is going to keep on going lower and lower. So that's the key thing. Is there a negotiation with China? The rest is not really spare change.
Nouriel Roubini speaking a little earlier on Bloomberg surveillance. This as we continue to watch breaking lines out of South Korea as well. We're now hearing from the Finance Minister, Choi Sang-mok, discussing countermeasures and strategies when it comes to dealing with the U.S. tariffs. Of course, he's held a ministerial meeting as he's now looking at coming up with support measures for the South Korean economy. South Korea has just ousted President Yoon with that constitutional court decision last week. And you can see the big sell-off right now in reaction to global recession fears, U.S. tariffs, the Korean won holding at that 1467 level. Let's bring in Bloomberg Seoul Bureau Editor Denny Thomas with me here in Seoul. Denny, so a lot of challenges now that the election has been triggered for an incoming president.
Right. Yes, and it's in a pretty bad time for the new president to come in. Not only he has to deal with this whole division in the country, but over and above, there's the huge Trump tariff that's come in. We have no clear direction as to where this is headed, and you need a tough negotiator to deal with Trump. So that is one challenge. And you see, look at the sell-off in the market, the short-selling ban that got lifted, probably not the best of the time, and the shorts are back and squeezing out big time. So yes, a whole lot of challenges ahead for the incoming president, and we'll see how the new leader shapes up to tackle these issues.
And as we continue to see the sell-off in Korean assets as well, investors very much focused on whether this new election campaign changes in domestic politics, what that necessarily means for reforms here across South Korea.
Yeah, clearly there are a lot of big-ticket issues that are on play here. I mean, people haven't yet spoken out because there's no date for the election, but clearly the whole corporate governance issue, which both parties have been going back and forth, how improve your commitment to the shareholders as well as the board. That's a big issue here. And also the Bank of Korea will be having a big challenge in terms of slowing economy, but at the same time not able to freely support the economy by lowering rates. So there are a lot of odds here for the economy to play out in the months ahead.
And you mentioned the Bank of Korea. Of course, we are seeing the growth slow down, but at the same time, prices surprisingly accelerating in March. And South Korea always with its issues with housing prices.
Yeah. Clearly, I mean, that has been an issue, and that is in the early days of late last year, that was a concern for them to not drop the rates. But the property market is kind of chugging along in a way, and that's going to be one factor that the BOK will be looking very closely as they try to decide what to do with the interest rates in South Korea.
Danny Thomas, good to have you with us, Bloomberg Seoul Bureau Editor here in our new Seoul studio. We have more ahead on the Asia trade. This is Bloomberg.
Stay here. taxes and deregulation were the three-legged stool, and right now the focus is on tariffs.
As things stand now, we're headed to recession. And it's very clear that this is a tax on businesses and households.
The U.S. is known for the innovation and the stuff we create, and I think it's exceedingly burdensome for small companies like ours.
In the next couple of months, the labor market still stays okay.
As the adage goes, if the U.S. is going to have a slowdown, other regions probably are going to be worse.
Business leaders as market experts as well talking to Bloomberg about the aftermath of those US tariffs. Let's take a look at how European futures are trading at the moment as a bloodbath just extends across Asia. We did see European stocks already plummeting into correction territory on Friday after that China retaliation news, looking like a pretty ugly picture there, particularly if the lead in Asia is anything to go by. We're seeing declines of upwards of almost 10% when it comes to Japanese stocks. Australia off by over 6%, and both of those markets looking like we'll see bear territory. This is Bloomberg.
What's going to happen with the market, I can't tell you, but I can tell you our country has gotten a lot stronger. And eventually, it'll be a country like no other. It'll be the most dominant country economically in the world.
Yeah, President Trump dismissing market concerns as he speaks to reporters aboard Air Force One after a weekend of golf in Florida. He's also talked about how he's not intentionally engineering a market sell-off, but of course we continue to see the repercussions across benchmarks here in Asia. Take a look at how the Nikkei is trading right now, because we're seeing every sector in the red, down more than 7%. The Kospi is also losing about 5% as we continue to see these safe haven moves towards currencies like the Japanese yen now trading at the highest level against the U.S. dollar since August. We're seeing a huge bid for global bonds, as well as the 10-year yield is now in the JGB's market at the lowest level since January. The offshore yuan also continues to be under pressure. Of course, we're watching the weakest level since February very closely. There's a lot of speculation on whether China could really turn to the weakening of the Chinese yuan in retaliation for these tariffs coming from the U.S. The Aussie dollar already saw the worst sell-off since 2008, and you can see the ASX 200 trading to the downside of 6%. This as we're following the latest on South Korea. Remember, South Koreans have just ousted President Yoon with the Constitutional Court upholding that vote to impeach him. We're hearing from local media Yonhap that South Korea has tentatively decided to hold the presidential election on June 3rd. Let's actually discuss all of this and, of course, the tariff implications and risks on reciprocal tariffs coming from the U.S. of 25%, not to mention auto tariffs. Our next guest says that Korea is being treated unfairly from the Trump tariffs. Joining us now is Han-Koo, a former South Korean trade minister and now a senior fellow at the Peterson Institute for International Economics. Great to have you with us today. Why do you say that Korea has been treated unfairly? I mean, it's sort of at a similar level than, say, Japan at 24%.
Korea has been a FTA partner with the United States for the last 13 years, and I believe that this FTA was really win-win. It really helped many U.S. producers and ranchers really grow market share in Korea. For example, the U.S. beef, Korea is the #1 market for U.S. beef. I mean, even bigger than 1.4 billion Chinese market. So I think it appears that Korea got the highest level of tariff among all FTA partners of the United States.
I remember even U.S. beef was such a big concession coming from South Korea. I covered the KORE's FTA negotiations. There were huge protests here. Yeah. Do you think perhaps the leadership vacuum that we've seen here in Seoul might have contributed to the fact that South Korea was not able to get a better deal?
Unfortunately, I think that is the case. As we know, the President Trump really emphasized this, personal leader-to-leader direct communication. But for the last 4 months of this, political turmoil in Korea, unfortunately, Korea didn't have such an opportunity to have direct, communication with President Trump. And I think that really contributed to what we see today.
Even if there were direct negotiations, President Trump wants this sort of transactional diplomacy, right? Hyundai Motor, for example, announcing $20 billion of investments in the United States just last month. They weren't spared from any of these tariffs. What can Korea give President Trump to appease him?
Yes, right now it looks like it's really turmoil, but if you just step back and look at sort of medium, longer term, I think there's a really, kind of a synergy to be created between U.S. and China. For example, one of the top policy priority of President Trump is to rebuild, these manufacturing sectors. And if you, remember, the Korea has been one of the biggest foreign investors in the U.S., semiconductor, EV, batteries. And right now, this shipbuilding, the defense industrial sector, bio, this energy, LNG, etc. These are the key strategic, focus for President Trump. And I think Korean companies can play a role in sort of collaborating with the U.S. and help the U.S. to achieve, that policy goal.
Do you think cooperation could be more difficult if we get a Democratic Party leadership here in South Korea who have traditionally been a little bit more skeptical with the relationship with Washington? Also, they had a different view when it comes to Beijing bilateral relations as well.
I don't think so. I think people tend to have this stereotype of what progressive versus, conservative Korea looks like. But the world has changed, especially this geopolitical landscape in Northeast Asia, and then with all this massive tariff, and especially with this 4 months of really, paralysis of politics and the economy, I see that more sort of pragmatic approach. I mean, no matter which candidate or party comes into power, I think there's a really widespread mood of sort of urgency and, crisis, mood in Korea. So I think this election will be like, is the economy stupid? The type of, the election, and also change election. So I remain hopeful that if, in 2 months' time, Korea put in place this new political leadership, I think that could really provide this political momentum to rebuild this the core, this ally and the partnership with the United States.
You talked about the changing world order, right? South Korea has benefited from a liberal free trade economic order around the world for decades. Now with more state interventionism just around the world, and we're talking not only about the U.S., we're talking about Europe, obviously China as well. Where does South Korea stand?
I think, as you mentioned, I think we are entering into new era of post-globalization. I mean, Korea has been one of the biggest beneficiary of this, this hyper-globalization for the last, few decades. But now, as you mentioned, state intervention, return of industrial policy, and retreat of this WTO and multilateral rule-based international order, and also securitization of economic issue. I think these are the new normal that we have to face. So, I mean, I think it's time for Korea also to change gears for like structural reform. I mean, now there's a structural reform around the world, and also Korea has to change, structurally.
We saw that the new normal was also potentially hedging and de-risking away from China.
Right.
But we're seeing these enormous tariffs on Southeast Asia, for example. You were just in Vietnam.
Right.
How does this really affect what companies can actually do here?
Yeah. I think, ASEAN is very important for Korea, Japan, and even for the United States, because I think one of the, important strategic goal of the U.S. is to really accelerate de-risking, or diversification from China-reliant, supply chain. And realistically, the ASEAN play a very important role to not replace, but, play a sort of a alternative role to accelerate this de-risking procedure. But if the U.S. really, imposes massive tariff on many these ASEAN, countries, I think it could slow down this achieving this strategic goal of the U.S. government.
Han-Koo, really good to have you with us here in our Seoul studio, brand new. Thank you so much for joining us, former South Korean Trade Minister and now a senior fellow at the Peterson Institute for International Economics. We have more ahead on the Asia Trade. This is Bloomberg.
Well, Chinese markets facing a grim Monday reopening after Beijing's retaliation to those US tariffs. But our Bloomberg opinion columnist David Fickling says China has already trade war-proofed its economy. He joins us now in Sydney. David, there's a lot of concern about the retaliatory tariffs, inflation pressure, growth pressure. But you think that they're in a better position than maybe we think they are?
I think so. Like, as you say, trade retaliation often doesn't happen because if you retaliate, you're just hurting your own consumers, and that's the sort of thing that eventually breaks down the trade war as a whole. But there's a couple of crucial differences in China. One is obviously, in all seriousness, the lack of free speech. Look at Jack Ma essentially disappeared from public life for 5 years for making some sort of fairly mild comments about financial regulation in 2020. So people are not likely to speak up, but also people are less likely to be hurt, because if you look at the groups of consumers who are being hurt by these things, in America the consumers and the imports from China are mass market consumer products, and in China the big imports from the US are intermediate industrial outputs. So it's a quite different group of consumers who are going to get hurt by retaliation.
The EU is already worried about anti-dumping, right? Excess capacity. Is that something that, you've written a lot about Chinese capacity. Is that something that we see play out?
Well, I mean, I think that's going to be less of an issue here because, of course, if you look at what Trump's trying to do with these tariffs, certainly under the Biden administration, there was a lot of talk about overcapacity, but that's really not that's not the fundamental issue that Trump's trying to crack down on here. His obsession is deficits, and this doesn't really fix the deficits problem. Let's have a look at some of those specific categories of goods that are imported from China to the US. It's things like smartphones, laptops, game consoles, Nintendo Switch 2 we've been talking about a lot, toys, furniture. It's things you'd find walking around a shopping mall or a Walmart. Look at the things that flow in the opposite direction. It's crude oil, soybeans, LNG, jet engines, plastic polymer feedstocks. You don't need to be an economist to see these are very different categories of goods, and they affect different groups in different ways. Industrial inputs it will raise costs certainly within China, but a lot of that cost can be raised within industrial companies' margin, and that's going to have a much more diffuse effect.
David, we were talking to the former Korean trade minister here in the Seoul studio just a minute ago, and he was telling us about how difficult it will be for companies to really de-risk and diversify away from China now, something that has happened for the past few years, given that other places like Southeast Asia are getting the brunt of the tariffs as well. Long term, looking at supply chains and looking at what you understand about China, how do you see the world economic order developing in the next few years?
I think you're seeing aspects of it already. It's very hard to diversify from China. It's the largest manufacturer. Its manufacturing output is almost sort of double that of the second country, obviously the US. If you look at those categories of goods that I've been talking about, the US is heavily dependent on China as an import partner. For things like smartphones, laptops, China makes up about 40% of imports. So it's very hard to diversify 40% of your import category to any country. Vietnam doesn't have the capacity for that. Malaysia, Thailand, India, they don't have the capacity for that. And of course, America is also imposing tariffs on all of those countries. So the only country you can really diversify to avoid tariffs is back into the US, where obviously your fundamental labor costs are just and your operational costs are simply too high. It's different in the other direction. China has already been diversifying its soybean imports to Brazil. Oil can come from Saudi Arabia, LNG and gas from Russia. So there's a lot of opportunity to diversify there. And I think what we're really seeing is the US cutting itself out of the international economic order with things like the RCEP, the East Asian trade bloc that was formed a few years ago. Increasingly, China is the anchor of these markets. And the US has an opportunity to build itself as what we saw under the Biden administration, trying to make links with places like Australia and Europe for sort of clean manufacturing and things like that. This really cuts it out of it, and we're seeing the US really disappearing into itself in a way that is not going to support its position as a player globally.
Xi Jinping loves to take this opportunity to say that China will be kind of the next great liberal champion of the world, right? Do you think, despite the hits that China will take to its economy, which is already weakened, it still will see this as an opportunity to overtake as that hegemonic power?
I mean, I think that's clearly the opportunity that's being handed to it. There's obviously a degree of hypocrisy in presenting itself as a champion of the international order, but genuinely, if you look at the narrative that's told out of Washington about China's rise, there's within both the Trump administration and the previous Biden administration, there's a lot of myth making about what's happened there. Chinese tariffs on international goods really have descended on a trade-weighted basis to about 3%, which is like a half a percentage point above what you have in the US. It was 10% in the early 2000s, or 12%. So, China is a much more open economy. It does want to create these, much tighter relations with the rest of the world. I wouldn't say it's a champion of the international liberal economic order, but at this point, neither is the US.
Bloomberg's David Ficklin there with the latest on the Chinese markets and really globally the world economic order, as well as we're now seeing a very messy Monday. Chinese markets returning from an extended weekend. And of course, we have to factor in Beijing's retaliation to U.S. tariffs as well. A gauge of Chinese stocks listed in the U.S. already plunging almost 9% on Friday. Asia Equities reporter Winnie Su joins us for more on what to expect today. Winnie, as we're seeing this huge sell-off across Asia already, how bad could it get for China?
Yeah, it seems to be a pretty ugly day today for Chinese stocks. Like you mentioned, Shery, Golden Dragon was down about 9%. And with that, Goldman Sachs actually trimmed its target for MSCI China and CSI 300, citing that tariff risks for Chinese stocks. So we have that risk for overall the risk assets, but it's going to hit Chinese stocks even more after they reopen from a long holiday. And we're watching closely these milestones for HSI, HSCI, about 2% away from the technical correction level, and HS Tech is also about 8% away from hitting a bear market. So things look quite ugly for Chinese stocks today, and some investors are also saying that after this sell-off today, we might see a bit of rebound heading into later this week if we see some more southbound support from the mainland investors looking to buy the dip.
So the near-term outlook is pretty ugly.
Yes, still. So even with some rebound later this week, driven by the interest in retail investors, we're hearing that over the next couple weeks or months, things are still looking quite pessimistic for Chinese stocks. We spoke to Bank of East Asia just yesterday, saying that we might see about 4 to 5% downside for HSCI in the near term, and that's because of that uncertainty around what Trump is going to say, and also how China would retaliate, and with the potential risks of U.S. recession and also affecting the export growth and the GDP of Chinese economy. Those are going to be factors that's going to weigh on Chinese stocks. But interestingly, what has changed this time, before and after the Liberation Day, is that before that, people were talking a lot about rotating away from some of the Asian stocks and into Chinese stocks. But that has changed after how China has quickly retaliated against the U.S. versus some of the Asian countries that are more open to negotiation. So the risk is heading really more towards the downside right now.
Bloomberg's Winnie Su there with what to expect from the China market opens. As we continue to watch some of the latest stories from the corporate front as well, Bloomberg has learned that President Trump was close to an agreement with ByteDance over TikTok's ban in the U.S., but the deal was called off after China withheld its approval following the announcements of reciprocal tariffs. On Friday, President Trump extended the deadline for the sale of TikTok's U.S. operation for another 75 days. ByteDance says any agreement would need to be approved under Chinese law. Bloomberg has learned that billions of dollars worth of acquisitions into IPOs are on hold as President Trump's trade war upends the global economy. Sources say ticket platform StubHub, fintech giant Klarna, and trading platform eToro have all paused their planned listings as markets extend deep losses. The stock rout is also affecting M&As, with companies like Saint-Gobain and KKR holding off on deals and others revising down revenue projections for the year.
Shery, take a look at what we're watching in commodities, and it is really broad downside, even taking into account that we've seen gold spot prices, of course, at record highs as one of these haven plays. But you can see that the downside when it comes to risk assets is so steep at the moment that we're seeing some of that loss covering taking place when it comes to profit taking on even gold at the moment. A lot of these really do make sense when you take a look at the concerns over the global economy and the impact on the Chinese economy and demand in particular. Copper as that China proxy, that brought a sort of global growth proxy off by over 6%, despite just a couple of weeks ago seeing a really strong surge in copper prices because the concern was that tariffs was going to dwindle global supplies. But now it is very much that global demand picture that is in play. You're seeking significant downside for the likes of nickel and iron ore as well.
Take a look at how the broader benchmark across Asia are trading right now as the sell-off continues, with the Nikkei losing more than 8%. The Topix Bank Index, in fact, losing again in the double digits, down 14%. Remember, they've already fallen about 20% or more. And the Topix has entered a technical correction, the Nikkei as well. The Nikkei, in fact, very close to entering bear market territory. If we close down about 4% in today's trading session, you can see down the downside with all sectors in the red right now as the Japanese yen continues to strengthen towards that 145 level against the greenback, the strongest level in about 6 months since October. We have stronger wage gains, but at the same time, of course, we are factoring in what really rising prices will do to the broader economy. The 10-year yield is also in Japan at the lowest level since January as we continue to see the global bond market rally. Treasuries also continuing to rally in today's cash trading session in Asia. The Kospi down more than 5% at the moment. We've heard from local media that we might see that presidential election happen on June 3rd. Every sector in the red, the worst foreign sell-off since 2021 already for South Korean stocks. Of course, that short selling ban has already been lifted. This is Bloomberg. It could get ugly in China. Of course, we are coming back from a long weekend in Beijing, not to mention the retaliatory tariffs coming from China against the U.S. tariffs. And you can see the Golden Dragon Index had already lost about 9% in the U.S. session. We have seen some gains for Chinese stocks year to date, up 13% for the MSCI China. Of course, there's been a lot of optimism about the country's tech advancements. But at the same time, given the latest global macroeconomic environment, Goldman Sachs has trimmed its 12-month target for Chinese equity indices this Sunday. The CSI 300 index outlook lowered to 4,500 from 4,700. Haidi, as we are continuing to watch those global bond markets as well, with the 10-year yield in China continuing to be pressured. Of course, we continue to see the tariff risks and also potential risk of more PBOC easing as well to support the economy.
Yeah, what's really interesting is the move that we've seen across yields in China in particular, right? Particularly as we kind of question where to next when it comes to the strategy on the yuan. But it's interesting, you're talking about at the same time, we've been talking about this idea of China typically being quite a compelling diversifier to U.S. assets, and at a time when, of course, a lot of people are looking for U.S. asset diversification, right? And Jefferies, for one, saying that some of those global money flows may well rotate out of the U.S. into places like Europe and China, where there is most evidence, quote, of improving fundamentals. So obviously it is going to be a pretty tough rejoining to the fray when it comes to Chinese risk assets today, but perhaps on a longer run, we are still seeing some views that perhaps there is a sense of kind of a tariff proofing that has taken place for the Chinese economy. Well, that is just about it for the Asia trade. Our markets coverage of the sell-off continues as we look ahead to the start of trading in Hong Kong, Shanghai and Shenzhen. The China show is next. This is Bloomberg.